Now, given there is no silver available to fill the chasm, it meant that significantly higher prices would have to be paid for cash settlements. Now, if you remember, liquidity providers had assessed there might have been just enough takers to let the cartel off the hook at $140 for the next rally point. But following first notice, this looked more like, and here, right at first notice, they realized there was absolutely insufficient silver to meet this demand, nor even by cash settling, or the cost to cash settle would have been more like about $230 and rising. That was enough to implode the entire derivative daisy chain of too big to fail banks.
The silver market is currently facing a catastrophic liquidity crisis in which the physical metal required to meet delivery obligations is unavailable. This shortage has forced a dramatic repricing of cash settlements as liquidity providers realize their initial estimates were woefully inadequate. While the banking cartel had hoped to cap the rally at $140 to exit their short positions, the reality of the supply chasm suggests that this price is insufficient to entice holders to settle for cash rather than metal. AndrewMaguire, an independent London metals trader, reveals that the actual cost to cash settle these obligations has skyrocketed to approximately $230 per ounce and is still rising. He warns that this price level is critical because it exceeds the balance sheet capacity of the too big to fail banks, threatening to implode the entire derivative daisy chain. The inability to source physical silver at lower prices has trapped these institutions, turning a manageable squeeze into a potential systemic failure. Now, we present the clips from AndrewMaguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Gold 8,000 and silver $140 are absolutely on track. In fact, as we're going to see, the 100% derivative-driven sell-off has reset the most powerful central bank sovereign and institutional physical global rally anchors in both gold and silver, this time with no long speculators to target. Now, without last Friday's officially sanctioned orchestrated bailout, which is what it was, and insufficient silver to meet over 1,500 tons of silver being demanded at the back COMEX door, the entire too big to fail cartel deck of cards would have folded. Now let's follow the footprints. Now, just for the record, I'm recording this just at the PM fix on Wednesday. So just to put that into context, and this is where we were when we did our prior episode. So this is about first notice. Following first notice into Thursday's pit close, and this is the point where all the open interest, all the warrants have to be fully paid up or delivered. And there was 49,455 million ounces of February silver warrants standing for delivery. They had to be fully paid for by way of a cash settlement, or, as should have been the case, 1,538 tons of bullion should have been moved across the warehouse centerline, the blue warehouse centerline, to be physically delivered. But the registered inventory data proves that silver simply wasn't there to deliver. Hence, the single largest official intervention since the 2008 Bear Stearns bailout. We'll look at how this contagion fed into mainland China shortly. As we estimated in our last episode, without a bailout, the entire cartel deck of cards will fold. Now, given there is no silver available to fill the chasm, it meant that significantly higher prices would have to be paid for cash settlements. Now, if you remember, liquidity providers had assessed there might have been just enough takers to let the cartel off the hook at $140 for the next rally point. But following first notice, this looked more like, and here, right at first notice, they realized there was absolutely insufficient silver to meet this demand, nor even by cash settling, or the cost to cash settle would have been more like about $230 and rising. That was enough to implode the entire derivative daisy chain of too big to fail banks. Hence, this is why they knew that there was going to be insufficient silver at this price. And what they were trying to do was get it down to this level here, or below even, to try and mitigate that by rinsing out as much long interest as they could. Now, our friend Bill Holter has always maintained silver is the Achilles heel that will one day be the failure, and a failure to deliver will occur, and it will create a trust shock in the derivative market to bring the entire too big to fail 2 quadrillion derivative deck of cards to come tumbling down. Now, also, once a higher price has been validated in the onshore and the western-facing physically settled free trade zone gold and silver corridors, the new benchmark price will have exposed billions of Fed-held OCC unallocated FX bets as undeliverable. And the longer a physical support condition endures, the stickier the rising physical support levels become into a series of higher-priced hedging flows, thereby underpinning each physical market support level. Hence, a panicked intervention so large it exposed a deeply offside weak hand. Now, while we anticipated the obligatory end-of-month selling into billions of dollars of Fed-borrowed gold leases, which have to be marked to market in the Basel III NSFR-compliant FX markets, and this is the FX market, and this is always timed to be collateralized at the CME pit close, which is exactly this point here. Now, the officially orchestrated selling we encountered was far more aggressive than had been anticipated, clearly, but nevertheless, it still fixed gold another $500 higher than the $1,000. It was initially over $1,000 higher. So they managed to retrace it too, but it was still $500 higher than in December. And this is a series of every single month we've seen higher and higher settlements. And this was enough to really force the Fed to buy back leases as at the next series of these higher prices. And in fact, they borrowed 15 tons more, and it still had to be paid back higher. But here's the point. While printing more fiat to buy gold to pay back leases simply raises the price of physical gold, printing more dollars does not buy silver that isn't there. It was derivative silver that really forced the sell-off, forced the official bailout, that is. Now, Fed BIS, that's the Office of the Comptroller FX silver bets that we talk about. These are the Office of the Comptroller is a registered report, and it lists billions of dollars of gold and silver bets, which are unallocated and are not deliverable, basically hedging a derivative. These also get marked to market at exactly that time. So, of course, this is the directly related pit close. So this is the same Bank of International's options point that we saw in gold. And this is where the too big to fail bailout was focused. This evidenced every single trick in the book being exercised, such as 30% margin increases designed to pop the spec bubble, opening COMEX market limit down, driving very large bid-ask spreads into which neutral market makers become naturally unwilling to make markets in. And with the CFTC conveniently largely absent into a partial government shutdown, rampant spoofing was evident. Now, into this directional sell-off, illiquid gold futures bid-ask spreads gapped as wide as an unprecedented $500 per contract. Now, it should be as tight as 10 cents, one tick. And with Shanghai silver also limit down, we evidenced COMEX bid-ask spreads as wide as $1. That's $5,000 per contract equivalent. These unprecedented illiquid conditions exposed the COMEX scam, the scam-enabled momentum traders who really control 80% of all the casino chips. And what it did was saw them flip from long, and they'd been long all the way up here, and they flipped short and drove the downside action all the way from Friday to Monday's London Open. And this was the London Open here, and better seen in gold. At this exact moment was when we evidenced central bank and sovereign buyers returning to buy the dip.
The silver market recently escaped a systemic collapse through an orchestrated bailout, as the physical metal needed to meet over 1,500 tons of delivery demands was missing from registered inventory. This shortage necessitated a desperate intervention to shield too-big-to-fail banks from a derivative implosion. Although liquidity providers aim to settle obligations at $140, the actual cash settlement cost has surged to approximately $230 per ounce. This disparity reveals a critical vulnerability, indicating that the banking cartel is ensnared in a derivative daisy chain that risks unraveling without a significant market reset. In response, aggressive suppression tactics, such as 30% margin hikes, were used to force prices down and liquidate speculative long positions. These actions caused extreme illiquidity, blowing out bid-ask spreads and enabling momentum traders to drive a sharp sell-off. Yet, this manufactured dip served only as a buying opportunity for sovereign entities and central banks who stepped in at the London Open to accumulate physical metal. The attempt to flush out leverage has not fixed the structural deficit, as the rising floor price confirms that physical demand continues to outpace paper manipulation. Let's get back to the interview.
Simply insufficient silver available to buy at any price to deliver. And therein lays the problem and the reason the too-big-to-fail bailout was implemented. While physically backed SGE exchanges reflect a liquid, real-time, physically determined supply-demand price where I have to own a bar to put it for sale. Diluted, leveraged CME, LBMA, unallocated silver contracts, they actually relate to just nothing but a complex synthetic derivative structure. They simply do not reflect the correct price. There's absolutely no doubt that the cartel operates as an insured agent for the wrong-footed Fed who audibly holds the short OCC foreign exchange gold and silver book. They actually hold that book. And by Friday, with no silver available to meet delivery obligations, the too-big-to-fail bailout was actioned. Now, the Western bailout tendrils stretch all the way into mainland China, where the only public fund investing in silver futures, which is the Western-sanctioned UBS SDIC Silver Futures Fund, had to be suspended from trading following being overwhelmed by redemption requests they couldn't fulfill. Now, the fund's secondary market price represented a 64% premium over its NAV, which when they shut the door, they literally shut the door to all new subscriptions and left investors exposed to massive losses. Now, to put this fund into perspective, this is a highly speculative derivative fund and is not related to the physically backed SGE exchange. And this is where that was called. Now, bottom line, this fund is so-called, quote-unquote, this open-ended fund, so-called hedged clients, these clients' silver investments with related COMEX positions, which became undeliverable when called off or at current prices. And of course, that market just broke. As such, redemption requests were unable to be fulfilled. Now, this redemption crisis contagion has now spread to similar highly leveraged virtual gold and silver platforms, also paper hedging price against a virtual COMEX benchmark. Even though they are not directly using the COMEX, they're using the price as a benchmark. These are derivative positions hedging derivative positions and have nothing to do with the SGE physically backed exchanges. This is one more reason that underpriced COMEX silver is being targeted by real SGE and Indian buyers who are once again lining up for a huge backdoor loadout of 49,455 million ounces, that's 1,538 tons of COMEX silver, which must be fulfilled by the 27th of February. This sell-off was designed to shake out buyers who'd stood for delivery, but Here's the problem. Speculators do not stand for delivery. These are real buyers standing for delivery of underpriced bullion to meet physical silver requests they cannot get delivery of anywhere else. It hadn't gone unnoticed, the low 71s, that Shanghai physical silver was trading at a $30 premium to futures, with strong demand evident into the dip at 100, which is where Shanghai was trading. Now, currently, as I record this on Wednesday, the SGE silver price is still $30 higher than SI silver futures, and it's hit its highest February fixed level. And then, of course, what we see is this is the same game we see all over and over again. As soon as it touches moving average, we see the same momentum shorts going short again. Now, this is actually manna from heaven, because what's happening here is the physical markets are literally taking this momentum shorts and converting them into physical. And while this large rinse has basically rinsed out a very large amount of speculators, and we're still seeing 36% backwardated conditions into the London fix. That's $1,800 per contract discount to London, illustrating the official intervention has rinsed out all the speculators, but it's not relieved the CME LBMA shortages, else we wouldn't have these large backwardations. As we'd highlighted in our last episode, the LPMCL short squeeze had crystallized massive losses for the cartel. Net of any legitimate hedging positions, COMEX front-month position limits are limited to 3,000 contracts. Now, that would have netted out to a 19 billion loss per member. And we had an example of that with TD alone. So into unprecedented silver shortages, if a 30% market sell-off could not have been orchestrated, which it was, it would have led to a potential too big to fail daisy chain collapse, and it still might. Any more attempts to target deeper moving averages will backfire.
The liquidity crisis has now triggered a contagion event in mainland China, forcing the suspension of the UBS SDIC Silver Futures Fund after it became overwhelmed by unfulfillable redemption requests. This derivative vehicle, which was trading at a massive 64% premium over its net asset value, effectively locked investors out when the paper promises could no longer track the physical reality. The implosion of this Western-sanctioned fund highlights the extreme fragility of synthetic platforms compared to physically backed exchanges like the Shanghai Gold Exchange, where ownership is absolute rather than theoretical. Despite an orchestrated 30% sell-off designed to flush out speculators, the physical market remains in severe distress, evidenced by a 36% backwardation relative to the London fix. This anomaly results in a $1,800 discount per contract, demonstrating that the official intervention failed to alleviate the shortage of 1,538 tons required for delivery. Genuine buyers are utilizing this suppression to stand for physical metal, trapping the banking cartel in a scenario where a failure to deliver could crystallize losses exceeding $19 billion per member, threatening the stability of the entire derivative daisy chain. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.